All right, let's talk about the construction sector. It's not every day you see a company post numbers that just pop off the page, but that's exactly what's happening with Ahhuvalia contracts. We're going to dig into what's driving this incredible performance and, more importantly, figure out if this is a flash in the pan or something that's really built to last. Let's dive in. So, you hear this phrase all the time, right? 100% growth. It sounds amazing, but what does that really mean? What does it look like when a company actually doubles its profit in just a year? It's one thing to say the number, it's another thing entirely to see it. Well, for Ahluwalia contracts, it looks like this. A staggering 104.8% jump. Yeah, you heard that right. Over 100% growth in net profit year over year. That's not just growth, that's an explosion on the financial statements. So the big question is, how on earth did they pull this off? Okay, so this isn't just a fluke, not just one lucky quarter. This really feels like a major turning point for the company. So let's get into the weeds and unpack these Q3 results. And here it is, plain as day. Just look at this chart. That bar on the left, that was last year. And the towering one on the right, that's this year, hitting over 78 crore rupees. They literally more than doubled their net profit. I mean, a jump like that, that's how you get everyone's attention. And this wasn't just some accounting trick. The engine room of the company, the operating profit, was actually firing even hotter, surging by almost 123%. What's really impressive, though, is that they pulled this off while also doing some smart housekeeping, like simplifying their company structure. That's going to pay off with better efficiency down the road for sure. But for me, this next point is the real kicker. Especially in an industry like construction, which is a business that just devours cash, the company is virtually debt-free. I mean, think about that. In a capital-intensive industry, being this financially solid is like having a superpower. It's a huge competitive edge. And if you want to see that superpower in number form, here it is, 0.04. That's their debt-to-equity ratio. To put that in perspective, for every single rupee of their own capital, they owe just 4 paise to someone else. That's not a balance sheet, my friends. That is a financial fortress. Okay, so the numbers are incredible, but great numbers can sometimes hide shaky foundations, right? So how do we know if the fundamentals are really solid? Well, a great way to kick the tires is by using something called the CAN-SLIM framework. Think of it as a rigorous checklist for high-growth companies. Now, if you haven't heard of CAN-SLIM before, no worries, it's basically a 7-point checklist. It was designed to identify the common traits shared by the most successful stocks before they made their biggest moves. It's a really proven methodology. So let's run Ahluwalia through the test. First up, C for current earnings. With over 100% growth, that's a huge check mark. Then A for annual earnings. The forecasts look really strong. Check. And N for new, as in a new catalyst. They've got a couple. That company amalgamation we talked about, and a strategic shift to higher value projects. So check and check. All right, next up is L, leader or laggard. Now look, you've got the Goliaths of the sector, like L&T, no doubt about it. But Ahluwalia is playing the role of the nimble hidden gem perfectly. They're proving to be quicker on their feet, and their profit margin recovery is actually outpacing many of the big guys. So, a fantastic report card so far. But the past is the past, right? The big question is always, can they keep this momentum going? To figure that out, we have to look at what's in the pipeline, their order book, and their game plan for the future. And wow, take a look at this number, over 16,000 crore rupees. Let that sink in. This isn't some hopeful projection. This is their locked-in future. It's a massive pipeline of signed, sealed, and delivered projects just waiting to get built. So what does a number that huge actually mean for the business? It means predictability. It means they have a crystal clear view of their revenue for the next 2, maybe even 2.5 years. In any business, but especially construction, that kind of visibility is priceless. And they're not just sitting back and coasting on this order book. Nope. The plan is to go out and add another 8,000 crore in new orders. But here's the smart part. They're not just chasing any project. They're specifically targeting high-margin private sector work with the goal of pushing their overall profit margins into the double digits. That's a solid strategy. Okay, so the fundamental story looks rock solid. Let's switch hats for a minute from an investor to a trader and see what the stock chart itself is telling us. Time for a quick technical snapshot. So if you're watching the charts, there are a couple of key levels everyone's got their eyes on.
There's a strong floor, what traders call support, down around the 870 to 885 range. And then there's a ceiling, or resistance, up at 927. If the stock can punch through that 927 level with some real power, that could be the signal for the next big leg up.
But honestly, here's a little detail that from me speaks volumes more than any line on a chart. The promoters have 0 pledged shares. 0. That means the people who run the company, the founders, haven't had to mortgage their own stake. It is one of the absolute strongest signals you can get about their confidence and the company's financial health.
So the fundamentals are strong, the management is confident, but who else is on board? Who's betting their own money on this growth story? Let's peel back the curtain and look at the shareholding pattern to see if the big money is moving in or out. Okay, first things first. The promoters, the insiders, still own more than half the company. That's exactly what you want to see. Their skin is firmly in the game. But look at the other big slices of the pie. We've got some serious institutional money in here from both mutual funds and foreign investors. And if you want to follow the smart money, as they say, check this out. The foreign institutional investors, or FIIs, didn't just hold their position, they added to it. They actually increased their stake from one quarter to the next. Plain and simple, they're buying more. And let's be clear about what that means. When you see large, sophisticated institutions like these putting more money to work, it's a huge vote of confidence. They do their homework. They're betting that the future looks even better than the present, and that tells you a story all by itself. So let's put it all together. You've got an incredible financial turnaround, a balance sheet that's basically a fortress, a massive locked-in order book that provides years of visibility. And on top of all that, you have smart institutional money buying in. So the big question we're left with is this. Are all these pieces falling into place for Ahhuvalia Contracts to have its next major breakout? That's the thought I'll leave you with. Thanks for tuning in.
Hello and welcome back to the Deep Dive. It is February 14th, 2026. Today we are definitely bypassing the usual sentimentality of the date.
We are. We're focusing on something a bit more structural.
A lot more structural. We're looking at a fascinating collision that happened today. A moment where the, let's call it hard data of a profit and loss statement crashed headfirst into the psychological data of a price chart.
It's one of those, those rare days where you get to see exactly how inefficient the market can be in the short term.
Right.
And then how violently it corrects itself when that information gap finally closes. We're talking about Ahhuvalia contracts, ticker symbol AHLUANAT.
And the reason we're highlighting this isn't just because the stock moved, it's because of where it moved from. We've got a scenario where until about, 24 hours ago?
About that.
The technical trend and the fundamental reality were telling two completely contradictory stories.
That is the perfect setup. You had a chart just screaming sell and a boardroom that was effectively screaming we have never been more profitable.
So let's unpack this. We're working with two primary sources today. First, the fresh financial results, which were declared today, February 14th.
And second, a technical candlestick chart. This one is from Nuvama, and it covers the daily price action from August 2025 right through today.
And I think we should state the mission up front. We aren't here to just read an earnings press release to you.
No, absolutely not. We want to understand the anatomy of a reversal. How does the stock go from being, a falling knife,
Which this absolutely was,
to a high conviction buy in a single trading session? That's the question.
Okay, let's start with the price action leading up to today, because context is everything here. If you pull up the chart for Ahhuvalia contracts and look specifically at January 2026, it is essentially a case study in bearish momentum.
It was ugly. I mean, there's no sugarcoating it. If you look back at December of 2025, the stock was trading pretty comfortably above the 950 level.
Yeah, it looked fine. It had structure. It had support.
But as soon as the calendar turned to 2026, it felt like the floor just gave way.
We saw this relentless drift lower. Throughout January, we're just looking at a series of lower highs and lower lows.
Which is the textbook definition of a downtrend. And it wasn't just a drift, it started to accelerate. By the time we got to late January, maybe the first week of February, the selling pressure really intensified.
It sliced right through that psychological 900 barrier, took out 850.
And it didn't stop. It didn't find a floor until it hit a low of 785.
That's a huge drop. That's roughly an 18 to 20% correction in about 6 weeks.
Right. For a construction company, which, usually trades on steady, predictable cash flows, that is a significant haircut.
It really is. It implies that the market was pricing in some kind of disaster.
Exactly. When a stock drops 20% without any specific news, the market is basically saying, we expect the upcoming earnings to be bad, or we think the whole sector is slowing down. The price action at 785 suggested a complete lack of confidence.
And this is where the technical indicators start to get really interesting. We often talk about oversold conditions, but looking at this new vomit chart, we saw something very specific with the Bollinger Bands.
Yes. For anyone who trades volatility, this was the signal to watch. The stock price didn't just drop, it extended aggressively, and I mean aggressively, into the lower Bollinger Band.
And just to clarify for our listeners who might use different parameters, we're talking about the standard 20-day to standard deviation bands here.
Correct. The standard setup. Statistically speaking, price action should stay within those bands about 95% of the time.
Okay.
So when you see a candle close at or even below that lower band, especially after a sustained drop like this one, it indicates that the selling has reached a statistical extreme. It's a classic mean reversion signal.
But, catching a falling knife at the lower Bollinger Band is risky. We've all seen stocks just ride that lower band down for weeks.
That is the danger, yes. You're right. Oversold can always get more oversold. But that's why you have to look at the secondary indicators. Take a look at the RSI panel at the bottom of the chart.
The relative strength index. It was deep in the danger zone during that dip to 785.
It was heavily oversold. And historically, when you combine a tag of the lower Bollinger Band with an RSI reading below 30, you are looking at a coiled spring.
Okay.
The sellers have exhausted their inventory. The weak hands, as they say, are out of the stock.
So technically, the setup was there. The chart was practically begging for a reason to bounce. But a chart can't bounce on its own. It needs a catalyst.
Exactly. Technicals tell you where the price is, and it was cheap at a statistical extreme, but fundamentals. Fundamentals tell you why it should move. And that brings us to the news that dropped today.
The earnings report, and frankly, surprise feels like a bit of an understatement here.
It was a blowout, a complete blowout.
Let's just get to the headline numbers. Ahhuvalia contracts declared their results today, and the net profit surged by 104.8%.
Let's just pause on that number for a second. 104.8%.
It doubled.
It doubled. In a mature industry like construction and infrastructure, you're usually fighting for single-digit margin improvements.
Right.
To see the bottom line expand by over 100% it's an anomaly.
Right.
It forces you to reevaluate the entire valuation model of the company.
But I want to play devil's advocate for a minute. Net profit can sometimes be noisy, right? It can be affected by tax deferrals, other income, maybe a one-off sale of an asset. Is this quality earnings, or is it just accounting magic?
That is exactly the right question to ask. If this was just other income, the market would see right through it and discount it.
Okay.
But if you look at the operating profit, the story actually gets even stronger. Operating profit grew by 122.8%, reaching 90.90 crore.
Wow. Okay, so that answers the quality question. Operating profit is the core business. That's the money made from actually building things.
Precisely. And the fact that operating profit, which was up 122%, grew even faster than net profit,
Which is up 104%.
is a very, very bullish signal. It means the core engine of the company is what's generating the cash. It's not a tax trick. It's operational leverage in action.
Let's talk about that leverage for a minute. For operating profit to double like that, it doesn't mean revenue had to double, does it?
No, not at all. And that's the magic of the construction business when it's run efficiently. You have these high fixed costs machinery, salaried staff, headquarters. Once you cover those costs, every additional rupee of revenue flows much more directly to the bottom line. Or, they've just managed to execute their projects with significantly less waste and better timeline management.
So just to compare the two timelines. In January, the chart is crashing to 785 because the market thinks something is terribly wrong.
Yes.
Meanwhile, inside the company, they're finalizing accounts that show they're making 90.90 crore in operating profit, a record number.
That is the inefficiency we talked about right at the top. The market was completely wrong. The price action at 785 was pricing in a deterioration of fundamentals. The reality was a dramatic improvement in fundamentals.
And when those two realities collide,
You get a violent repricing, which is exactly what we're seeing on the screen today.
the stock has recovered all the way to 899.90.
It's a massive move. We're talking about a recovery of over 100 points from the lows. Just huge.
And looking at the chart now, that recovery looks very different from the dead cat bounces we saw in early January.
It does. Look at the shape of the candles. We're seeing these large green real bodies. That indicates that from the moment the market opens to the moment it closes, Buyers are in complete control. They're chasing the price up.
And I'm noticing the volume bars at the bottom of the Nuvama chart.
Oh, yeah. Significant participation. This isn't just retail traders nibbling at the bottom. The volume that's accompanying this move suggests institutional accumulation.
Yeah, the big funds.
The big funds that might have been on the sidelines, or maybe even short the stock, are now forced to scramble for shares because their entire thesis has just been blown out of the water.
And the RSI has reacted sharply, too.
It has pivoted. It's no longer in that depressed, oversold region at all. It's angling upward. It's crossing above its signal line. This just confirms that momentum has shifted. The wind is now at the stock's back.
So we have the move to 899.90, and we have the Y, the 78.57 crore net profit. But I want to explore gap that still exists.
You mean the valuation gap?
Exactly. We established that back in December, the stock was at 950. At that time, the market was basing that price on the previous quarter's earnings.
Right.
Which were substantially lower than what we just saw.
Right. The old reality supported a price of 950.
So now we have a new reality where profits have doubled. Yet the stock is at 899.90. It's still trading below where it was when the company was half as profitable.
And that is the provocative part of this deep dive.
It just feels counterintuitive. If the news is so good, why aren't we at a new all-time high immediately? Why are we just recovering?
Well, there are a few layers to that. First, there's what you could call market memory. Investors who bought at 950 and then had to write it all the way down to 785 are, they're traumatized. As the price gets back near 900, many of them are just happy to get out with a smaller loss. They start selling into the strength, which creates resistance.
The break-even psychology, just let me get my money back and I'm out of here.
Exactly. That supply has to be absorbed. But the second factor is skepticism. The market often underreacts to these massive shifts initially. It asks, is this sustainable? Or was this just a one-quarter wonder?
But with operating profit up 122%, that feels like a structural shift, not just a lucky break. You don't accidentally become twice as efficient.
I would agree. And that suggests that the current price of 899.990 might still be inefficient. If you apply a standard valuation multiple to the new earnings, the intrinsic value of the company has likely shifted much higher than that old 950 resistance level.
So the move from 785 to 899 was the correction of the error, the market fixing the mistake of selling it down so hard.
Yes, that was the market basically saying, oops, we were wrong, it's not going bust.
And the next phase would be?
The next phase is price discovery. Now that we know the new baseline is 90 crore in operating profit, what is the fair value? And that's where the technicals will be crucial again. We need to see if the stock can actually break that previous resistance at 950.
And if it breaks 950, technically that opens up blue sky territory.
It does. And structurally, it would make sense. You now have the fundamental fuel, the earnings, to justify a breakout.
I want to circle back to the listener who might be looking at this and thinking, well, I missed it. It already bounced from 785 to 900.
That's a common reaction. FOMO, the fear of missing out.
But based on what we're discussing, it sounds like the easy money of the reversal from oversold is made, but the smart money of the repricing might still be on the table.
That's a very fair assessment. The risk profile has completely changed. At 785, you were buying a falling knife with no news. That's high risk, high reward.
Sure.
At 899, you're buying a company with confirmed triple-digit growth. The price is higher, but the value proposition is actually much, much clearer now.
It's the difference between gambling on a bounce and investing in growth.
Precisely. And this is why the convergence of these two worlds is so powerful. If you only looked at the chart today, you'd see a stock that has run up fast. You might think it's overextended.
No.
If you only looked at the earnings report, you'd be wondering why the stock isn't way higher.
You need both eyes open.
You need to see the Bollinger Band bounce to understand the entry, and you need the P&L statement to understand a potential destination.
So let's try and summarize the takeaway here for Ahhuvalia contract.
Sure. I'd say number one is the trap. The market sentiment in January was way too bearish. It drove the stock to a statistical extreme at 785, right on that lower Bollinger Band.
Right.
2, the catalyst. The February 14th earnings report revealed that 104.8% jump in net profit and the 122.8% jump in operating profit. The game changer.
Okay.
3, the pivot. This fundamental news validated the technical oversold signal, driving a really high volume recovery up to 899.90. And 4,
The opportunity.
The opportunity. The stock is still trading below its pre-earnings highs despite having structurally better financials, which suggests a potential efficiency gap still exists in the price.
It's a classic example of why you just cannot trade in a vacuum. The chart gave the signal, but the earnings provided the conviction.
And it serves as a great reminder to watch those earnings dates. Volatility often crushes the unprepared, but it creates incredible opportunities for those who have done the homework.
Before we close, I have one final thought.
Mm.
We talked about the efficiency of the business improving. In construction, that often means they're clearing out old, lower-margin order books
Yep.
and moving into newer, better-priced contracts.
That is the life cycle of the industry. Absolutely.
So if that's the case, this 90.90 core operating profit might not be a spike. It might be the new floor.
And if that is the new floor, then $8.99 is cheap.
That is the thought we will leave you with. As always, do your own due diligence, but keep a very close eye on how AHLU Conti behaves around that 950 level. It's going to be a battleground between the old market memory and the new fundamental reality.
And the market usually sides with the money, eventually.
Thanks for tuning in to this deep dive on Ahhuvalia contracts. We hope this helped bridge that gap between the squiggles on your chart and the numbers in the spreadsheet.
Goodbye, everyone.
See you next time.